Okay, let me begin by briefly introducing our moderator, Professor David Missirian. Our moderator, Professor Missirian, specializes in courses involving business law. His teaching interests include real estate law, contract law, UCC, and ethics. He earned his JD from the University of Tulsa Law School. In addition to teaching at Bentley, David is a title examiner for the Commonwealth of Massachusetts and a real estate attorney. He is also a member of the Real Estate Bar Association. And with that, I will turn the conversation over to David. Thank you for being here today.
Thank you very much, Abby. I'm also a state certified examiner for salespersons and real estate brokers. So I teach them what the law is for those things, and then I certify to the state that they are qualified to sit for the examination. We have a whole series of experts here on varying topics. What I'm going to do is turn it over to them in a minute so that they can tell you a little bit about themselves. And then what I'm going to do is I've tried to cull through some of the questions that you all posed so that we're talking both about financing, we're talking both about buying real property, we're talking about the laws that are involved in those issues. One thing I wanted to touch upon before we started, when you use the words affordable housing, for all of us in the industry, that triggers certain things. There is literally a category called affordable housing. Affordable housing is a real estate category that is different than housing that I can afford, or how do I afford to buy real estate. So I tried to make the questions that I'm going to ask our panel kind of go across all those spectrums. Okay, so the first person I'm going to ask to identify himself is Hans Brings. So Hans, if you could take it away, and after Hans, we'll go to Bryan Brown, and then from Bryan Brown to Brian Sykes. So Hans, take it away if you could.
Thanks. Name is Hans Brings. I graduated from Bentley years and years ago, back in 1989. No offense to you, David, but David was my professor in real estate, as well as my mentor, got me into this business. I've been in real estate since 1990, helping buyers and sellers come together. I've been a top agent in Massachusetts since 1995, and loving every minute of it since. Still do it today. I've actually have my own charity called the Hans Brings Results for Children's Charities Fund, which also donates back to charities, local children's charities throughout the area, which has been fantastic as well, giving back to the community.
Brian?
Yep. All right. Thank you. Thank you all. Welcome. Thanks for joining the call, everybody. My name is Bryan Brown. I graduated from Bentley in 2002, a long time ago. I currently live with my wife and our three little roommates in Hopkinton, Mass. We've been there for 6 years now. Absolutely love it. But I've been in the mortgage industry for, this is going on my 20th year. It's hard for me to even say that, but I absolutely love it. I love, like Hans said, I love working with, I love the industry. I love working with first-time home buyers and educating people on how to, accomplish the American dream of home ownership. So I'm excited to be here today and answer any questions that you have. So thanks for having me on.
Brian Sykes.
Yeah, good afternoon. Yeah, Brian Sykes. I got everybody beat with graduating from Bentley in 1987. It's hard to believe. And then worked a part-time MBA and finished it up in 95. I've been blessed to be in the commercial mortgage banking industry now going on 23 years. My most current situation is running the Boston office for a company called Lumint. And I have been specializing in multifamily financing on a national level over the last 23 years, focused on Fannie Mae, Freddie Mac, and HUD, and doing it with multifamily owners, anything from 5 units up to multiple 400 or 500 unit projects, again nationally. So it's been a exciting field. Been through up and down cycles, and kind of been watching my younger guys at the company never dealing with a high rate interest environment that we are now joining. So it's really going to be a learning experience for all those guys. So delighted to be here and look forward to chatting with them.
Thank you, Brian. So as you can see, we really have a wealth of knowledge here and a really deep set of knowledge. These are people that have been in the industry for decades. And the benefit of that is to being able to comment on cycles that happen in our real estate industry and the different facets of that. So as they would say, without ado, let me get to one of the questions. So the question for the panel is, will rising interest rates put a damper on the price of housing, and potentially in what way will the rising interest rates affect the housing market? So any of you feel free to step in and take a swing at that one.
I'll shoot up first. So, we've been at much higher interest rate. Back in 1990, the interest rates were 12, 13%. In the 80s, we were back in the 18% range. So although, 6 to 7% is higher than what we've seen over the past few years, the median has been closer to that 5, 6%, at least over the last 30 years. That said, it affects buyers' affordability, plain and simple, right? If you are pre-qualified, and I'm sure Brian's will both tell you, if you're pre-approved, pre-qualified for 900 back when the rates were 3.5%, it certainly takes you down a notch, maybe to around $650,000. So your affordability is lessened. There's no doubt about that. Another part of it is expectations. So those people that were looking at that $900,000 home back when rates were 3.5%, unfortunately are now looking at that $650,000 range, and they're not finding those same properties with those same amenities out there. So it's really, it's gotten people a little discouraged, but we've seen prices start to come down just a little bit simultaneously. I don't believe we're going to see them come down to the point of equaling, the percentage of the rates having doubled. But, we had such a crazy market over the past couple of years with COVID, with the lower interest rates, with the higher demand, with everyone wanting to be in their own homes because they're working from home. Demand went so sky high that everybody that was looking, back 6 months ago, they were finding themselves having to offer $50,000, $100,000 over the listing price just to get a home. And many of those people still didn't get their property. So if you want to look at the silver lining here, the nice part about it is it's kind of balancing out the market a little bit. So where you're looking for a home, you're getting a chance at it. You're perhaps, there's still multiple offer scenarios, but you're not competing against 18, 20 other offers. You're getting an opportunity to buy a home in this market. So the demand is still there. It's balancing out the market a bit. And I think that's a positive of all this.
I can take a little discussion on multifamily and the value of apartment communities, and we're still trying to see how the impact is. I think everybody's gone into a little bit of a holding pattern to try to see where it lands. Like the single family housing market, the apartment multifamily market has been red hot. Same concept, multiple offers, people signing away 30-day closing and waiving reports and due diligence to actually win the deal, and putting up $1 million deposits and non-refundable. So it's the insanity that's plagued the single family market has been the same in multifamily. And kind of as Hans brought up, I'm fairly confident to say that there isn't going to be a direct correlation between the interest rates going up and value decline for similar reasons. But one of the things people figured out that unlike office buildings and retail, there's an implicit kind of a support system governmentally behind multifamily, as we saw during COVID, and Fannie and Freddie step up with liquidity when times get tough. So I believe that the cap rate, which is kind of how we value the apartment communities, are going to obviously go up as interest rates go up, but probably not in lockstep, because the demand was so red hot. The people still see the value in multifamily. The rents continue to be stable in going up in most markets, and very few are showing small declines. Combine that with the fact that it's the best piece of real estate asset class still over all the other in terms of risk. And so, and compare that to the stock market, the volatility, obviously some competition now with CDs and fixed income, but it continues to be a very desirable investment medium. So to be determined, obviously going to be softening, but not, I don't think it's going to be any sort of debacle like 2008 or in the late 90s.
Brian, anything to add?
No, I mean, these guys hit the nail on the head. I'd be reiterating, I just, in a quick sentence, I just don't see, even with to answer the question directly, I don't see rising rates having that much of a major impact on home prices just because of the demand problem they both talked about. So I would agree.
Very good. So this one, Brian, actually might be directly to you. Will rising interest rates affect borrowing rates and or the ability for people to qualify for loans?
Yeah, okay, so this one would be me. So just so we're clear, when the Fed raises rates, which they're likely to do in an hour and 45 minutes, again, that does not, the expectation is they're going to raise the Fed funds rate another 75 basis points. That does not mean that mortgage rates are going up 75 basis points, which is 0.75% at 2 o'clock. Okay, they're two separate things. Okay. The Fed funds rate, by the way, for those who don't know, is the interest rate that banks lend money to each other. Okay. Now they're raising rates to curb inflation, right? And where it seems like we're kind of getting to that peak of inflation, and for some items, inflation has already started to kind of come down. So it's having the effect that they're looking for by raising the Fed funds rate. You're going to start to curb inflation. Now, typically, historically, when inflation starts to come down, mortgage rates are going to come down, right? And or if we enter into a recession, by some metrics we kind of are there, by others we're getting there. If we enter into a recession, and typically in recessionary times, interest rates would drop as well. So it kind of seems by all metrics, and from a lot of the calls that I've just been on nationally, we are going towards a lower interest rate market. All right. So the bad news is I think we're still on the rise in the short term, but in a long run, meaning probably 6 to 12 months out, we're probably going to be in a lower rate environment. Setting a realistic expectation, I think we probably can get into the 8 to 9s before we start to come down and probably land somewhere in the 5s to 6s. Right. So just the days of 2 and 3 probably behind us. It took a pandemic to get there. Unlikely that we'll get that low again. I think landing somewhere in that 5 to 6 range is probably a realistic expectation.
And if I might add, and I've been in the market for 38 years. It is, and Hans brought this up, it's what most people don't realize is the rates were at 18% at one point. So the 5 or 6 compared to that is still a good interest rate. Is it as good as 4? No, but it's not 18. So you really got to take things kind of in perspective.
Right. And real quick, David, so to answer this, maybe the second part of your question, or just to provide a little color to this, right? So I ran some math on a $500,000, just kind of to your point, on a $500,000 loan at 4%, the payment would be $2,379 principal and interest. At 7%, it's $3,307. You're talking about a $900 difference per month on a $500,000 loan, right? So the answer to your question is, yeah, will it affect the ability? Absolutely, right? I mean, so as rates drop, it's going to get the Hans said it earlier, purchase power will go up accordingly. So absolutely.
So the third question someone asks is, if you're a first-time buyer or a prospective buyer/builder, are there any positive things you can tell me about today's market?
Well, as I think I had already mentioned, the positive side of it is hopefully you won't have to go up against 18, 20 multiple offers. and actually secure a property. I've had so many folks over the past year that have been looking for over a year now, make offers on a property every weekend, and just lose and lose and lose. And it's discouraging, it's disappointing, it's frustrating. I mean, you're trying to buy a home, you've got, all money in your pocket, you've got your pre-approval in hand, just finding a place to live has been very challenging. And now you're hopefully, with the increasing rates, again, nobody wants to have to pay more, but paying something is all what this is about. Let's get into a property instead of, paying rent for a property. So I think that is, as I mentioned before, I think that's the silver lining to all of this.
And on the lending side, I think a silver lining is the industry has evolved a little bit. The mortgage industry, in case for any of you who are not aware, there's a program out there called the Mass Dreams program. This is a program where you can get up to $50,000 as a grant. You don't owe it back to cover closing costs and down payment, depending on where you live and how much money you make. And I'll provide some links where people can look at that. But that's something that evolved out of this, right? I'm not sure we would have had something like that if we didn't have it prior to 2022, and it's something that's evolved from this. And there's other unique programs that have come back, like 2-1 buy downs, right? That's another unique product that came out to get a buyer lower interest rates in the first couple of years of the loan. That's a whole nother conversation I could have, but just the point being, unique mortgage products have started to come back to help people afford homes and get back into the market.
And Brian, it sounds like what you're saying to me, and this is actually a really good thing to bring up, given our next question on demographics, that there are actually a lot of programs out there, and I'm using the word a lot, but at least some that I'm not even aware of, where one is a grant. So that's a potential of getting money without the obligation to pay it back. Certainly there are going to be, guidelines for that. And there are other programs that make that initial step into the water of owning your own home, which is certainly a scary thing to do, making that easier for the first several years, given what's going on. So you actually have, a lot of different avenues that are a broader conversation than we can have right here, that people might want to reach out to you and say, hey, this is what I'm thinking. This is what money I have. What's available, what's out there.
Yeah, it was obviously not a sales thing for Brian, a guaranteed rate mortgage. This is, whenever you are talking to your lender, ask them what all the different options that they have are. If the lender says, well, I don't really have any, you put 5% down or 10% down or 20% down, that's kind of what we do. You might want to, talk to some more folks. Like, I'm sure awesome agents like Hans can have a network of lenders that they work with that have all these, access to all these programs. Just make sure the lender you're working with is got a diversified, products, I guess, let's say, and you'll be fine.
And
My only,
go ahead, Brian.
I was going to say a more broad scope, which affects all of both Hans and Brian's business as well, is just the lending community this time around, unlike the 2007, 2008 era, has been much better behaved and disciplined in terms of their underwriting, how they've handled it. So that although rates are up, the liquidity is there. The lenders that have done a good job are all in business. Yes, has there been a little bit more of a cautious tone maybe in multifamily side, on my side, that my guys are going to all have to put more equity into their deals, I think. But in terms of by good behavior on the commercial side, that flows down into the residential side. And I think the good news is, the lending's still there. It's just obviously the rates are higher, but at least the liquidity is there for people, and it's not a problem with people accessing debt markets.
And I know that Bryan Brown and Hans will not say this themselves, but I'm more than happy to do it. I've worked with both of these individuals over the years. I think they both will admit that I am, and as I say this is in humor, I'm an old short guy, but I am more than happy to tell the truth. And it's what I always try to do. And I don't deal with people that lie. I don't deal with slick, fast-talking people. Both Bryan Brown and Hans Springs are very, very, very knowledgeable individuals. They are straight shooting individuals. They are helpful individuals. They are people that are kind individuals. So you take that for what it's worth, okay? I'm more than happy to tell you the horrible things that I know about both of them. I don't know of any. And so let me move on to the next question after having said that. The next question I'm going to actually answer, the person said, is housing equally accessible across all demographics? My answer to that would be yes. It has to do with what your perception is. First, so that you know, Massachusetts has one of the most stringent set of lending and sales requirements, buying requirements of any state that I know. Can you discriminate in buying or selling real property? The answer is really simple. No. I mean, if you'd like to engage in that conduct, I'm more than happy to report you to the licensing board and you can lose your license immediately. In terms of lending, there are massive changes that have been in effect in the last 5 or 10 years where I do not want to say that it doesn't happen, but the things that you read about in the news, I'm involved in buying and selling of real estate on a daily basis. I do not see it happening in our lending industry. In fact, there are all sorts of requirements and things that have been put in place that make it really, really, really difficult for that to happen. I think where people are making a mistake is they're saying, well, can everyone buy or sell or borrow money whenever they want? No, they can't. Why? Well, because borrowing money is a balance between risk to the bank and what you bring to the table as a borrower. It's a numbers kind of thing. So if you don't have any money saved up at all, if your credit history is not good at all, well, if that is considered a demographic, well, then yes, you're putting yourself in a position of not potentially being able to buy a home. Why? Well, because you're not a good risk. That doesn't mean you're not a good person. It means that from a fiscal perspective, banks are going to say, and so that we're very clear, it is not Bryan Brown that is saying that. This is not Guaranteed Rate that is saying that. This is the federal government who lends money to banks that is saying there are these guidelines, these limits to which we will let you lend money. And if you fit outside those limits, then what you need to do is work to fit within those limits. And what might that mean? It might mean that you need to start saving some money. Why? So that you can have enough to make a down payment, to maybe make a 5% down payment or a 4% down payment. And I'm doing this very fast, very broad brush. If you put no money down, the number of lenders that can accommodate that is going to be very small. If you put 5% down, you're making that broader. If you're putting 10% down, you're making that broader. If you're putting 20% down, you're making that broader. So what am I saying? I'll give you an example. This is an old example. I told you I'm an old person. When my mother bought her very first home, she saved money for 10 years. She read magazines at the library. She didn't buy coffee at expensive coffee shops. She took every nickel and dime she could possibly save and saved it for that down payment. Am I telling you you have to wait 10 years? No, but I am telling you you may have to wait several. Why? To improve your credit, pay your bills on time, make sure you're doing all those things. And I will tell you that there are people like Brian and others who will look at your situation and tell you, hey, if you can do these kinds of things for the next few years, that may put you in a much better position to buy homes. I think I can honestly say that at least in this area, the Boston area, Massachusetts in general, we are not seeing as many of the horrific stories that you may be seeing on the news. And primarily because there are laws in place that prohibit that. And it comes up pretty fast. We have testers that go out to test people like Hans and other brokers to see if you are discriminating on the basis of race, color, religion, sex, national origin, military status, family ancestry, sexual orientation, etc. And if you are, you will lose your license. I mean, we're all really very cognizant of that, and we're blessed that we don't see a high rise in that. That's just really a misnomer. What we are seeing is a lot of people who are just haven't been able to save enough money. And again, how you accomplish that, Brian is somebody that can help you with that. Financial counselors and advisors can help you with that. I'm not trying to make excuses because I think the industry in Massachusetts is really doing quite well. Is buying your first home hard, scary, take sacrifice? Yeah, it does. Doesn't mean it's impossible. It means that it requires a certain amount of foresight, discipline, and you might not be able to do it today. But I think that each one of us on this panel here could tell you how it could be accomplished in several years. And I know years sounds like a long time, but it's really not. Think of how fast you got through Bentley. You came in year one, and before you knew it, it was year 4 and you were leaving. So setting your focus on a goal and trying to accomplish that goal is something that we can show you how to do, okay? Question number 5. When people speak about, and now panel, I'm talking about specifically what comes to our mind when we say affordable housing as a category. Does affordable housing units, does that change? Is that a city thing? Is it a state thing? What exactly is the category of affordable housing?
Well, go ahead. So affordable housing, so I live and work in Waltham, and we have an affordable housing project right now for condos for sale in Wellington Crossing. Wellington Crossing is a large condominium complex just off of Trapella Road. And in order for the developer to develop that complex, they were required to put into effect what is called a 40B statute, which basically mandates the developer to count 20, I think it's between 20 to 25% as affordable units. So these units have to be sold at a sales price that someone in the 80% of median for that town could afford. That is what I would see as affordable housing. And that is the only complex right now that I know of in Waltham that had that. Again, when we talk about affordable, it's kind of interesting because these units on average go for right around $600,000-$700,000. The affordable units go for $293,000. These units, you still have to qualify. Not only do you have to qualify for income-wise, according to the city, you have to be under that median income level, but you also have to qualify for a lender like Bryan Brown in order to afford that affordable housing property. And it's challenging because if you have that lower income, yet need a higher income in order to qualify, it takes a combination of having even a higher down payment to offset the income levels, which makes it a bit challenging. I've had a lot of people come through these units. I mean, everyone loves hearing that they can buy this unit for, less than half the cost of what other folks are paying for it, but not realizing that it's so challenging to qualify for, which is unfortunate. And I know other towns have other affordable housing projects, properties. I'm just referring to the one in Waltham. And every town has a different set of median price qualifications and so on and so forth that it has to abide by. So that's, my 2 cents on affordable housing.
Yep. If I could jump in and maybe just talk a little bit on the rental side to expand upon affordable housing, which is something that we do on a national level. And the first to touch upon it, as Hans just brought up, the area median income is something that's set in each community, or what we call MSAs. For example, the Boston MSA, believe it or not, is not just the city of Boston and in the suburban areas like Waltham, et cetera. It also, believe it or not, stretches all the way up to southern New Hampshire. And that's called the Boston MSA, and they set an area median income for that area, as well as at more local levels. So there's different programs around the country that qualify different things based on a percentage of AMI. So one of the things on the rental side, and I'm going to simplify it because it's quite complicated based on household, whether it's a 2-bedroom unit and you have a 4-member family or a single family. A real simple analysis is if the area median income is $100,000 and I have an apartment unit that qualifies at 60% of area median income, you basically take $100,000, take 60% of that at 60,000, and then assume 30% of your income can go to housing or rent, which in this case means that if I had an apartment generically and it was subject to a 60% area median income regulation, that I couldn't rent it more than $1,500 a month. And the market rate could be as high as $3,000 or $3,500. Again, I'm simplifying it in terms of every unit type and every family unit has a different number, but we could spend an hour on that, and I don't want to do that. The reason this is important is for a couple of reasons. As Hans brought up, the 40B is a Massachusetts concept where if I want to build an apartment deal in Weston and everybody comes out at town meeting and says, oh, we don't want a new apartment project because, it's going to put pressure on our schools, et cetera. We don't want our people. If the town of Weston does not have met their affordability, the developer can override the local level and get approval under 40B and build a 200-unit property as long as he set aside 20% of the units at 80%, or you can actually do a combination of 60% and a little bit less. That allows them to build the property and then ensures some affordable housing. The 80% of AMI has been helpful for like teachers that live in town or fire chief, police, and that type of thing. It's not very deep affordable, but it provides some help for an upper and middle class type family that rent. Now, the other area that affordable housing gets built is looking at things at 60% of area median income or below. You can get a concept called tax credits. And tax credits basically are a government program. Each state has allocated them, and developers can then apply for them. And the reason this is important is if a developer is going to set aside 30-40% of its property as affordable housing at lower rents than what they could get from market, they need an incentive. The incentive is less equity to put into the deal. So if I'm building a property, I normally have to put 20% equity into it. I got to look at a return analysis on that 20%. But if I can go out like some very savvy affordable developers can do and get tax credits and put almost no equity in the deal, my return's almost infinite. So if I can put no money in, build a property, get cash flow, and in return, I have to set aside 30-40% at these affordable ranges, that's a win-win. Developer is making a good return, his partners are making a good turn, and there's units that are fairly deeply affordable for families and individuals that are trying to get an apartment, or in the case of some people here, maybe an apartment where they can get in and then work on saving their down payment for their house. So it's the third way to incentivize affordable housing in the rental market is through real estate tax abatements. Some cities, New York City being one of them, is quite astute at it, where if I agree to set aside I can, for a certain percentage of my property is affordable, I'll qualify for not having to pay any real estate taxes, say for 10 years. In some communities, even longer, Texas. And affordable housing, the last thing I'm going to wrap it is unfortunately for us, the New England market's the hardest place to do affordable housing because we have a higher area median incomes than the rest of the country. A lot of the other areas of the country, it's much easier to be naturally affordable because the market rents aren't as high, but the area median incomes are, maybe $50,000 or $60,000 a year. So it's easier to qualify for these programs. It's very difficult, which is why we have a shortage of affordable housing in the Boston area and in New England in general because of that. And so that's causing a lot of stress on our affordability here, and then creates the issue of, kids having to rent from their stay at home with their parents because it's so expensive to get apartments, or putting 3 or 4 renters in one unit to afford it. So that then parlays into Hans and Brian's world, because if they're not saving their down payments, it's harder for them to then qualify for the mortgage. So it's kind of a cycle, and there's been a lot of emphasis on it. Fannie Mae and Freddie Mac are looking at new programs to continue to encourage affordable housing in terms of lower interest rates, other incentives, et cetera. So it's a big issue, but that's kind of the affordable housing in a nutshell. It's a science. We could teach a whole class on it, but that's kind of a short version of it.
So clearly a very big topic, affordable housing. And again, what he was speaking about is what we in the industry call affordable housing. It means a particular type of housing as opposed to ones that I can purchase. And I'm going to segue with that into a question that someone online posed. They read the Boston Foundation recently reported that the median price of a single family home in the region was $763,000. And they said, how could anybody save enough money as a down payment to purchase something like that if it's the median? Hans, I'm going to direct this to you if I might. Are there, and I'm going to kind of modify the question, one, what region do you think they were talking about, number one? And two, are there still homes available for $300,000 a year? Or $300,000, excuse me. Yeah.
It depends on your geographical search. I mean, Waltham is still considered a pocket of value. We're surrounded by Wellesley, Weston, Lexington, Newton, Belmont, which are dramatically, higher price range, higher median price. In Waltham, currently our median price is $700,000. Is that considered affordable? Oh, in comparison to the towns around us, yes, very much so. That said, the further you go out from Boston, obviously prices, continue to go down. But then again, it comes down to your search. How far do you want to be away from work? How far do you need to be away from Boston? And that all comes into play when you are looking for a home. I mean, I always tell folks the first step in buying a home is getting that pre-approval. The second step is trying to decide in the geographical area that you want to focus your search on, and then figuring out what towns in that area actually fit your budget. I guess that's kind of a long answer to a short question, but I think the affordability question is all relative to what you're looking for, what area you're looking in, and what's surrounding you.
And that makes a lot of sense, Hans, because if you think about it in this way, and this is again a traditional viewpoint, it's a long-term viewpoint. The closer to Boston you're going to be, the higher the pricing is going to be. There are a lot of communities, and Hans mentioned, many of them that have always been a traditionally higher priced kind of place. So if you are purchasing in those areas, yes, your median is going to be up around 700,000. Having said that, at least in Massachusetts, if you go west, outside of 128, your pricing is going to start to go lower the farther west you're going to be. is that a bad thing? Well, bad is relative, because if where you're going, the houses are farther apart and you kind of like that, they have a decent school system, and maybe you're somebody that doesn't have to commute but can do what they do online, then it really doesn't matter how far out you are. So yes, you are going to be able to find things, in that lower price bracket. You got to kind of understand this. You may say, well, but I want to live close to Boston. Okay, that's a choice you're making. If that's the choice you're making, you're going to be stuck with those higher priced kinds of things. And part of the reason they're higher priced is exactly the thing that you're saying, because it's close to Boston. Okay, well, that's just a fact. That's kind of like saying, I want to eat ice cream, but I don't want to gain weight. You've got to kind of balance things one against another. And it may involve, and I recognize I'm getting kind of sounding like a broken record. It may require you to move out a little farther initially. And you buy that first home, and it's not in the ideal place you want to be. But over time, the value of that house will go up. You have been paying into it. That will increase the equity that you have. And so now when you sell that, you may be able to move, into a second home that might be closer to what you're looking for, or have the amenities that you're looking for. Years ago, it used to be a process that, there was something called a starter house that was a smaller 1, maybe 2-bedroom home that you bought, not in the ideal area that you want to be in, but it was something that it was a stepping stone to the next house and the next one after that. So people need to kind of re-embrace that older kind of tradition. Let me get to another question. What is the current gap between asking and selling price?
I guess that's another question for myself. I think it depends on the listing price to begin with. Was it a reasonable price? Was it priced competitively, meaning that they wanted to entice multiple offers on the property? Was it priced high? You need to obviously look at other properties, look at what we call comparable sales, what other properties have been selling for, determining if that price is competitive, aggressive, or conservative, meaning potentially even too high. There's no exact percentage. I mean, this past weekend, I put a couple properties on the market. One of them sold with 3 offers, well over list price. The other one is still on the market, and hopefully we'll get an offer next week. I think, reasonably speaking, if I had to say what exactly has been the average over the last couple months, I would say sellers are still being reasonable within that 95 plus or minus % range. I don't think sellers are willing to just accept 10% less than what they're asking for a house, whether they're asking the right price or not. And at the same time, there are some properties that are still selling, over list price based on the fact that there's multiple interest and higher demand still.
Thank you. And I have a question here, and this is, I think, a Brian question. Do you have any idea how high the mortgage rates might go in your crystal ball, Brian?
Check it up. I think I kind of addressed it. I think we'll end up somewhere in that 8 to 9% range before we'll start to crest and hopefully go back down. But I'm only regurgitating things that I've heard from people a lot smarter than me.
But you've also commented a little bit that there are programs out there that you're aware of and other lenders are aware of that might be beneficial to people who are trying to put less money down or might be potentially purchasing in a given area.
Yeah, exactly. So the Mass Streams one, and I'll put these into the chat here, but there are 2 that really jump out as examples, right? For the time that we have here, I'll just speak to these. The Mass Streams is the $50,000 grant. Depends on where you live now, not where you're going. Boston qualifies, certain zip codes. And then that's one. That's the grant program. And then the other one is the 2-1 buy down. So in a simple, to just help people understand it. So let's say the market rate is 7%. A 2-1 buy down is for the first year of the mortgage. The rate would be 5%. It's 2% less, 2-1 buy down. For the second year, it would be 1% less than 7, which is 6. So it'd go 5, 6. And then from years 3 through 30, you would be at the market rate at the time you locked the loan, which let's just say is 7%. Okay, now the best thing that could happen is if you get into one of these programs and then a year from now, interest rates drop, you never really get to that 6 and 7% range. You would just refinance out of it and get a lower rate for the life of the loan. That would be sort of like your best case.
Are there any loans still out there for people putting 3 or 4% down?
Yeah, and I was gonna mention that earlier when the question came in. The purchase price was $763. I tried to write the number down quickly, but yeah, I mean, I get it, right? If you think you have to put 20% down, it's almost impossible, right? But if you can, I mean, for veterans, right, still doing 0% down. There are pockets of Massachusetts that will qualify for USDA, which is 0% down. Nowhere near Boston, as you might imagine. Inside 128, very slim or very seldom. But as you go further west, there are more rural areas. Out where I am, I'm in the Hopkinton area. There's a lot of places around here that would qualify for 0 down. Mass housing is 3% down. FHA is 3.5% down. Fannie Freddie are both 3% down for certain incomes. Actually, it's not income restricted anymore. So I would just, in general, most people will qualify for as little as 3% down.
And I want to thank you for that, Brian, because I also sense the kind of gloom that we're shoving out here a little bit. And I wanted to have, there are options. So for those people who think, well, gosh, I'll never get a house at 700,000. Maybe not right initially, but you may be able to find something a little less, and you may, as Brian said, it'll only be 3 or 4% down. So things are doable. You need to speak to the professionals that we have to help you with that. We also have, and Brian, you actually, I think, covered this. Are there any special programs which might aid first-time home buyers or low-income persons who purchase in a particular area?
Yeah, I answered it. What I'll do is I'll just take this second to just type, just to put the links into the chat, which people can grab. The first one I'm going to do is just tell you is the Mass Dreams one. The first piece you need to figure out is, are you living in one of the towns that would qualify for that $50,000 grant? And then the second link is how to see if you're eligible. So what happens is you first apply through Mass Dreams just to see if you're eligible. You cannot go to Mass Housing to get money for the loan. You still have to go to a lender like Guaranteed Rate or whatever institution you want to get your money from that is qualified to lend Mass Housing. So you have to go to the lender to get the money, but we underwrite it by Mass Housing guidelines. So I'll put both of those links in now.
I appreciate that, Brian. Someone asked, what is the most important thing for a prospective buyer to do when thinking about borrowing money for a purchase?
So I'm on mute. Oh, sorry, Hans. So for me, it's start with the payment, right? Like that to me is just, I'm staying in my lane here of on the lending side. What payment are you going to be most comfortable with? And it's not, that may sound car salesy because they sort of do that to you in the car sales world. Like, where do you want your payment? It's not like a sales thing. It's an affordability thing. Because if you can tell me you can afford $4,000 a month for a mortgage payment, I'm going to back out what the expected taxes would be, the expected insurance. That'll leave me with my principal and interest payment. Then I can reverse engineer what your purchase price would be based on how much money you have to put down. So to me, the most important thing is it going to be affordable for you? I mean, if it's not affordable, I can't put you in the loan, right? I mean, we got to do everything that we possibly can to help you get the house, but also make sure we're not setting you up to fail. So staying in my lane, it's payment first.
Hans, you look like you were about to say something.
Oh, I totally agree with Brian. That's what I was going to suggest. I mean, it's all about, getting that pre-approval and make sure you're comfortable with payment, because you can qualify for perhaps a lot more, and I've seen it happen. But the budget that you're comfortable with is really the key.
And I'm going to chime in just a bit on this. Sometimes what we want and what we should get are two different things. I've seen sometimes couples, certainly during the tech boom, two people in the tech industry, a couple were earning tremendous amounts of money, and so they basically bought a home that put them, I don't want to say outside of their financial bracket, but right up the upper level. And when I saw them do this, the first thing that entered my head was, no one's considering the fact that one of them might lose their job, or something might happen that puts them in an uncomfortable financial situation. And so when Brian is saying, what are you comfortable with? Because I'm a lawyer, I always think about the what ifs. Yeah, it's great if our income stays at this level. It's great if I get the raise, etc. But what happens if I don't? So sometimes the concept of what I want and what I really should do might be different. So I would only say, if I can just barely afford $3,000 a month, maybe you should think about not borrowing $3,000. Would you feel better if it was $2,500? Well, yeah, but then I can't borrow as much. Okay, that might be telling you something. It's not for me to tell you what to do, but as Brian said, and I think that says a lot about Brian. I would hate you to get something where I can say to myself, you know what, in a year, these people are going to be foreclosed on, or they're going to have to try to sell this house. And that would be a horrible thing to have happen. And none of us want to see that happen to you. Okay. Someone asked, should I rent for a while prior to buying, or maybe rent to own?
I'll start. I would just say, just briefly, again, staying in the mortgage lane here. I would say, if renting will allow you to make yourself a stronger buyer, then sure. So on the lending side, we really focus on three things, right? Your income, which is your debt ratio, your assets, and your credit. So if renting will allow you to save more money, and meaning add more assets to your profile, your financial, whatever you want to call it, or it will allow you to eliminate debt. Both of those are going to make you a stronger buyer, right? And then the same thing goes with credit. If renting will help you, if you're a 650 now and renting for a year would help you get to a 750, that's going to get you much better interest rates and open up more lending doors for you. Then yeah, I would say absolutely, because maybe Hans can speak more to this than I can, or I know he can, but it's like, it's very likely that, the spring market, it could be a little bit of a frenzy again. And there could be a lot of buyers out there, and, there may be the bidding war situation. The stronger you are as a buyer, the more money you have to put down, the better credit you have, the better chance you have of getting your offer accepted when you're competing against a similar, another buyer with a similar price. So that's my thing. If you can make yourself a stronger buyer, absolutely. I think it makes sense.
And it depends on your personal needs. I mean, when do you want to get into a home buy? What is your personal situation? Life is short. I mean, it's interesting when people try to time the market. I mean, it's like trying to time the stock market, or, gambling down at the casino and think it's red versus black. I mean, nobody knows, what's going to come up next spring. Will prices be higher? Will interest rates be higher? My crystal ball is not ideal, and I'm sure Brian's isn't. Neither Brian's is perfect either. We don't know. We know what's now. If your desire is to own a home and you're in a position to be able to buy one, and go for it. If you want to rent for a while, put yourself in a better borrowing position for next year. You think that's the best situation for you? Awesome. Different strokes for different folks.
I think renting is similar to the decision tree you do with buying a house, right? you have three options. If you can find a rent-free option, and a lot of young kids, even my son's age, both my sons are 25 now. They're out in their own apartments, but many of their friends are staying at home, saving money for maybe that first condo. My son has three other roommates living in not the best section of South, although, you know, he gave up being in the best areas, a little bit on the edge, not the greatest neighborhood, but good enough. And he's got three other roommates, and he's keeping his rent fairly low, so he can save. My other guy's down in New York City, which is an impossible formula to save there. But the point is, it's a sacrifice on, do I want the Class A apartment that really is impressive and nice in the best neighborhood, or do I sacrifice living in a less desirable, more affordable apartment community, and then be able to save more? And as both the Hans and Brian mentioned, you know, to be able to make yourself a better candidate for both financing and for home ownership. So again, it's just as David mentioned in the beginning, you're making a decision even on the rental piece of your life and sacrificing to get to that next step, if that's important to you.
And just so that we're aware, and I know that Abby is going to tell me I have under a minute to say this. Again, like anything we do, there's a sacrifice. By that I mean, do I live close to the MBTA? Because I don't have a car. How far do I have to walk, to take the train? Is it close to a supermarket? If I don't have children, then, being close to a school might not be an issue. Each one of you is a different person and in a different situation. And it's balancing your relevant factors against the relevant factors that the market has. Is it fair to everybody? I would have to say, yes, it is. And unfortunately or fortunately, each of us has different things to bring to the table. Some of us may have to save a little bit longer than others. Some of us may want to be in a particular area because it's where our family is, but we can't do that right now. Doesn't mean you can't do it ever. It just means sometimes what we want takes a little bit longer, but each of us can succeed. Abby?
Thank you, David. I just wanted to take a moment, since we're just about out of time, to thank all of our panelists for sharing their knowledge and helpful advice. In that email going out, I'll be able to share with our attendees your contact information. So if they have any further questions, they'll be sure to be able to reach out to you via email. So thank you so much, panelists, for speaking with us today. Thank you, David, for moderating and leading such an interesting and helpful discussion. And lastly, I just want to thank our audience for joining us. I hope you enjoyed the program just as much as I did and learned a lot. And I wish you all a wonderful week. Thank you.
Bye-bye now.
Thank you very much.